Welcome again, ECO151 student, to the third session on elasticity. In this session, we will cover other demand elasticities. Recall from the previous week's work that the demand of a product also depends on other factors other than the price of a good. Therefore, we will consider other variables like the income of consumers and the price of related products. Our discussion will start with income elasticity, followed by cross price elasticity of demand, and then we will focus on the price elasticity of supply thereafter. Income elasticity of demand measures the responsiveness of the quantity demanded to changes in income. That is, we are now examining the relationship between quantity demanded and income, ceteris paribus. In simple terms, we want to know by how much will the quantity demanded of a product change following a change in consumer income. The income elasticity coefficient is calculated as the percentage change in quantity demanded of a product divided by the percentage change in consumer income. The calculated coefficient can be positive, negative, or equal to 0. When the price elasticity of demand coefficient is positive, this means that an increase in income will lead to an increase in the quantity demanded of a product, and the reverse is true. Products with a positive income elasticity of demand are known as normal goods. Normal goods are further classified into two, namely normal luxury products and normal essential products. Normal luxury goods refers to goods with an income elasticity of demand that is greater than 1, whereas normal essential goods have an income elasticity of demand coefficient that lies between 0 and 1. When the price elasticity of demand coefficient is negative, this means that an increase in income will lead to a decrease in quantity demanded of a product, or a decrease in income will increase the quantity demanded of a product. Products with negative income elasticity are called inferior goods. An example of such a product is bread. For some people, as their income increase, they substitute the consumption of bread with other wheat products such as rolls, buns, and others, but when their income decreases, they revert back to the consumption of bread. The term inferior does not mean that the product becomes defective nor has a problem, but it simply reflects the negative response of quantity demanded of a product when income changes. The knowledge of income elasticity also helps firms in the manufacturing sector, as they will know and concentrate more on the products that will boost their revenue given the economic circumstances they face. For example, under the COVID-19 pandemic, it may be profitable to produce more inferior products to boost revenue flows. Table 5.3 illustrates some interesting results of income elasticities in South Africa. Although the data is somewhat outdated, go through these elasticities in the table and try to find out the justification for the outcomes cited. Another factor that affects the quantity demanded of a product is the price of related products. Crossprice elasticity of demand measures the responsiveness of quantity demand of a product, say product A, following a change in the price of another product, say product B. The coefficient for cross-price elasticity of demand is calculated as the percentage change in the quantity demanded of product A divided by the percentage change in the price of product B. If the calculated coefficient is 0, then it means that the two products A and B are unrelated. An example of such a relationship is between a change in the price of margarine and the quantity demanded of motor cars. If the calculated coefficient is positive, it means that the two products, product A and product B, are substitute goods. Therefore, a change in the price of one good causes the quantity demanded of the other good to change in the same direction. Examples of such products are butter and margarine. If the calculated coefficient is negative, it means the two products A and B are complement products. Therefore, an increase in the price of good A will cause quantity demanded of good B to change in the opposite direction. Examples of complement products include motor cars and motor car tires. Now, let us focus on the price elasticity of supply. The price elasticity of supply measures the responsiveness of quantity supplied of a product to changes in the price. That is, we want to examine by how much will the quantity supplied change if the price of a product change by 1%. Price elasticity of supply is calculated as the percentage change in the quantity supplied of a product divided by the percentage change in the price of the product. Since the price of a product and quantity supplied has a positive relationship, the elasticity coefficient of supply is always positive, hence it is easier to interpret. The relationship between the quantity supplied and the price of a product can be further explained by the different categories of supply, which are 1. Perfectly inelastic supply, where the elasticity coefficient is equal to 0. Inelastic supply, where the elasticity coefficient lies between 0 and 1. Unitary elastic supply, where the elasticity coefficient is equal to 1. Elastic supply, where the elasticity coefficient lies between 1 and infinity. And perfectly elastic supply, where the elasticity coefficient is equal to infinity. Let us look at each category in detail. When the price elasticity of supply is perfectly inelastic, the elasticity coefficient is equal to 0. This means that the quantity supplied is unresponsive to changes in the price of the product. For such a product, suppliers are willing to supply a fixed amount of the good irrespective of the price. The supply curve for such a product is characterized by a vertical supply curve. When the price elasticity of supply is inelastic, the elasticity coefficient is greater than 0 but smaller than 1. This means quantity supplied is less responsive to changes in the price of the product. More technically, we say the percentage change in quantity supplied is less than the percentage change in the price. This is illustrated by an upward sloping linear supply curve that intersects the horizontal axis. When the price elasticity of supplies is unitary, the elasticity coefficient is equal to 1. This means the quantity supplied changes with the same proportion as the change in the prices of a product. For example, if the price of a product increased by 10%, then the quantity supplied will also change by 10%. An upward sloping curve that passes through the origin has an elasticity coefficient of 1, indicating that the percentage change in quantity supplied is equal to the percentage change in the price of the product. When the price elasticity of supply is elastic, the elasticity coefficient is greater than 1 but less than infinity, this means that the quantity supplied is relatively more responsive to changes in the price of the product. That is, if the price of the product increased by 10%, then the quantity supplied will increase by 20%. Any upward sloping linear supply curve that intersects the vertical axis of the price axis has an elasticity coefficient greater than 1 but less than infinity. When the price elasticity of supply is perfectly elastic, the elasticity coefficient is equal to infinity. It simply means that any quantity of goods can be supplied at a given price. This implies that the amount of goods supplied in the market depends on the market price of the product. The supply curve for such product is characterized by a horizontal curve. Now let us examine the features that determine price elasticity of supply, and these are time, price expectation, stockpiling or excess capacity, and the availability of inputs. Firstly, the price elasticity of supply depends on the time that has passed since the change in prices. Most supply curves are inelastic in the short run and more elastic in the long run. This is simply because in the short run, suppliers have less time to adjust their production or respond to changes in prices. However, in the longer run, they have more time to adjust accordingly. Secondly, price expectations are important determinants of supply elasticity. If the expected change in the price of a product are regarded as long-term phenomena, then suppliers will be more likely to adjust their production. In this case, supply will be more elastic. However, if they perceive the change to be temporary, then supply will be more inelastic since they will be less likely to change their production. Thirdly, products that have a possibility of being stockpiled has a more elastic supply curve as compared to products that cannot be kept for a longer time, that is, perishable goods. Fourthly, if a firm or supplier has excess capacity, they have a greater ability to respond to a price change as compared to firms that operate at full capacity. And lastly, if essential inputs in to the production process are not easily available, then firms cannot easily adjust their production following the changes in prices, hence supply will be more inelastic. The table 4.5 reflects a summary of all the elasticities that have been discussed thus far. Please go through this table and make sure you understand the way each is calculated, the different possibilities, as well as the description of the elasticity coefficients. More so, use the exercise book to practice many questions on elasticity. Thank you.